There is a number that every financial analyst on Earth was watching on Tuesday morning. Not a missile count, not a casualty figure, not a barrel price. A number whose movement tells you more precisely than any military briefing or diplomatic communique exactly how much the market believes Trump when he says this war will last 4 to 5 weeks. The number is the VIX, the volatility index, the instrument professional traders call the fear gauge, the single best real-time measurement of how uncertain the people managing the world's money believe the next 30 days will be. On Tuesday, March 3rd, the VIX hit levels last seen in October. That means the professional money managers running the world's pension funds, sovereign wealth funds, hedge funds, and insurance portfolios are now pricing the next 30 days of this war as among the most uncertain 30-day periods in recent financial history, and the markets confirmed it in every time zone in sequence as each exchange opened and read the same data. Japan's Nikkei dropped 3.0%, China's CSI 300 fell 1.5%, Germany's DAX lost 4.2%, London's FTSE All-Share sank 3.3%, New York's S&P 500 lost 2.2%, the MSCI World Index, the broadest measure of global stock market performance, covering 23 developed economies and approximately $60 trillion in market capitalization, posted its worst single day since the June 2025 12-day war. Not its worst day since the original strikes on Saturday, not its worst day since the Rosslaufen shutdown on Monday, its worst single day since the day the last war ended, meaning Tuesday, March 3rd, produced worse financial damage than any single day of the first 5 days of this war. The question is, why Tuesday and not Saturday or Sunday when the strikes began? Because on Saturday and Sunday, markets were closed. On Monday, professional investors applied the standard geopolitical playbook. Sell cruise ships and airlines, buy defense stocks and energy, hold the tech majors, wait for clarity. The playbook said wars typically don't last long enough to materially damage corporate profits. The playbook said oil supply disruptions resolve within weeks. The playbook said America wins. Then Trump told the New York Post the war could last 4 to 5 weeks and with the capability to go far longer. Then the Pentagon chief said the goal is not regime change. Then the U.S. Embassy in Riyadh caught fire. Then CENTCOM confirmed 3 dead Americans and 5 seriously wounded. Then a THAAD battery was destroyed. Then Secretary Rubio said America produces 6 interceptors per month against Iran's hundreds. The playbook stopped working by Tuesday morning. South Korea felt it most viscerally. The KOSPI, the country's benchmark stock index, the world's hottest major index just days earlier, the index that broke 6,000 for the first time in history on February 25th and hit an all-time high above 6,347, fell 452 points on Tuesday, a 7.24% collapse in a single session. $270 billion in market value erased. The largest one-day wipeout since the August 2024 yen carry trade meltdown. Foreign investors dumped more than $3 billion in local stocks. The won slid to its weakest level in nearly a month, $270 billion, gone from South Korea alone in one trading day. Because South Korea imports virtually all of its energy, and the Strait of Hormuz carries a critical share of that energy, and the strait is now conditionally closed at Iran's discretion, while the American Navy that was supposed to keep it open is operating from bases that have been struck, with aircraft carriers that came under fire, and interceptor stocks that the Pentagon itself says are running low. But the number that broke every model and the number that no analyst had a framework for was not in the equity markets. It was gold. Gold prices slid more than 5% on Tuesday, to $5,141 per ounce. Silver futures fell more than 8%. Gold miners collapsed. Hecla mining down 15%, Kerr mining down 13%, gold down 5% on day 5 of a major war. In every previous geopolitical crisis of the past 50 years, every war, every market sell-off, every moment of institutional uncertainty, gold went up. Not always by much, not always for long, but up. Because gold is the safe haven. Gold is what institutions buy when they don't trust anything else. When the dollar looks risky, when bonds look risky, when stocks look risky, gold is the destination. That is the entire financial logic of gold's role in the global monetary system. On Tuesday, March 3rd, gold fell 5%, while everything else fell simultaneously. That is not the safe haven trade working. That is the safe haven trade breaking down. When the safe haven trade breaks down, it means institutional investors are not running to safety. They are running to cash, specifically to US dollars. The dollar rose 1.1% on its DXY index against the world's major currencies, its sharpest single-day gain since May last year. Meanwhile, bonds sold off across every sovereign market simultaneously. Dollar up, bonds down, gold down, stocks down. That combination, every asset class declining at once except the dollar, is the specific financial signature of a deleveraging event, not a geopolitical sell-off, not a war premium being priced into energy, a deleveraging, the forced sale of assets across every category by institutions that need to raise cash because their risk models have been breached and their margin calls are arriving faster than their liquidity can cover them. The bond market rally that professional investors spent January and February building, the rally that reflected expectations of lower inflation and lower interest rates across 2026, has been erased in 1 week of war because the war has done something no central bank policy, no trade tariff, no technology cycle can easily reverse. It has simultaneously raised the price of oil, raised the price of gas, disrupted the shipping lanes through which 20% of global trade moves, and created the realistic prospect of a 5-week or longer conflict that keeps all of those pressures elevated indefinitely. JP Morgan told its clients on Tuesday, the sovereign wealth funds, pension funds, and institutional investors who collectively manage more money than the GDP of most countries, that this war generates greater macroeconomic risk than any recent military conflict, greater than the US intervention in Venezuela, greater than the Israel-Iran conflict of June 2025. That assessment, landing in every institutional inbox simultaneously, is what drove the MSCI World to its worst day since June. Not missile counts, not casualty figures. JP Morgan's macroeconomic risk note. Now consider what comes next, because the market is not asking about what has already been struck. It is asking about what has not. ING's research note, distributed to every professional bond trader in every major financial center on Tuesday morning, identified the precise question that determines where this goes. The focus, ING wrote, will now be on whether Iran can escalate its attacks on the production facilities of the region's key marginal energy suppliers. The key marginal suppliers, not Ras Laffan, that is already shut, not Ras Tanura, that is already halted, the facilities that have not yet been struck. Abqaiq, the Saudi processing facility that handles 7% of global oil supply in a single installation. Ghawar, the world's largest conventional oil field, whose output underpins Saudi Arabia's entire export capacity. The offshore platforms in Abu Dhabi's ADNOC Sea complex. The Kuwaiti export terminals at Mina Al Ahmadi, 1.7 million barrels per day, feeding Asian refineries with no alternative source. If any one of those facilities is struck, not destroyed, just disrupted, the oil price trajectory JP Morgan has modeled does not stop at $100. Wood Mackenzie's Alan Gelder told clients that number directly, $100 per barrel if tanker flows are not quickly restored. $100 is not just a headline, it is a threshold. Cross it and a cascade of corporate cost increases begins appearing in quarterly earnings reports in April and May. Airlines, shipping companies, chemical manufacturers, food producers, every company whose input costs include energy or whose products travel by sea. That is the moment the stock market's assumption that wars don't materially damage corporate profits gets tested against actual profit and loss statements from companies that spent March buying jet fuel at a 60% premium and shipping cargo through a strait the American Navy was escorting at gunpoint. One of the more measured voices on Wall Street put a specific boundary on all of it. 1 month is manageable, he said. Beyond that, the calculus changes significantly. Under 1 month, corporate profits are largely intact. Supply chain disruptions are temporary. Energy price spikes reverse as markets find alternative routes. Beyond 1 month, energy costs embed in input prices. Input prices appear in consumer prices. Consumer prices trigger wage demands. Wage demands force central banks to keep rates higher for longer. Higher rates depress valuations across every asset class, and the 2026 rally, the Kospi at 6,347, gold at $5,300, the S&P at 6,900, starts reversing in ways that cannot be attributed to any single headline. Trump said the war could last 4 to 5 weeks. 4 weeks is 28 days. 28 days is exactly the 1 month boundary where manageable becomes structural. And his upper estimate, the capability to go far longer, has no published endpoint. On Tuesday, March 3rd, the Dow lost 403 points, the S&P lost 0.94%, the MSCI World lost 2.7%, South Korea lost $270 billion, gold lost 5%, European gas added another 27.8% on top of Monday's 39% surge, and Trump announced the U.S. Navy will escort tankers through the Strait of Hormuz, the strait that Iran has mined, that Iran has conditionally closed, that Iran has used to sink and damage multiple vessels, using the same Navy whose bases have been struck, whose Lincoln came under fire, and whose interceptor stocks the Pentagon says are running out. The market is not panicking. The market is calculating. It is calculating 4 to 5 weeks of oil above $80, European gas above $60 per megawatt hour. South Korean semiconductors facing energy disruption, global bonds repricing for higher for longer inflation, and a Federal Reserve that cannot cut rates into a war-driven energy shock without destroying its credibility. That calculation produced Tuesday's sell-off. Wednesday's calculation depends on what Iran fires next. Share this with everyone you know right now. South Korea lost $270 billion in one session, its worst day in 19 months. The MSCI World posted its worst day since June 2025. Gold fell 5%. The safe haven trade is broken. JP Morgan told clients this war carries greater macroeconomic risk than any recent conflict. ING is asking whether Iran escalates to Abqaiq and Ghawar next. And Trump's 4 to 5 week timeline sits exactly at the 1 month boundary where manageable becomes structural.